The session before lunch, Solly, was called Reasons to be Cheerful. And this isn't a Reasons to be Cheerful panel session in itself, but it completely talks to the same kind of messaging, doesn't it? I want this afternoon to be very much about having better conversations with clients. And really where we're going to focus on this one is around nature and the fact that people, I mean, I've seen some amazing presentations over the years about people doing work on regeneration and really cool stuff, and you know, whether you're planting trees or just making sure that rivers are put back where they were meant to be in the first place to stop flooding, all that kind of work. But it's not only that, it's a lot bigger than this. This is regular businesses need to do stuff better too. Everything across the board needs to say, okay, so what's our impact on nature, biodiversity, the world, whether it's land, sea, air, whatever it is. So this session will focus on that. And we've got two fund managers here who specialize in that, who run funds in this area. So I shall just ask you to briefly, firstly, introduce yourselves, and then we'll come on with the questions. So, Shi, would you like to start?
Sure. Thanks for the opportunity, Julia. It's a pleasure to be here. I go by my last name, Shi. I'm from Pictet Asset Management. My job is I'm a client portfolio manager and engagement specialist. What that essentially means, and for our thematic equity strategies, by the way, what that means is that I help raise impact capital and steward impact capital. And we can go into what that means and how we define things. And one of the strategies that we launched 3 years ago is called regeneration. It takes a holistic approach to focus on biodiversity. And we will talk about that later as well. Yeah.
Great. Thank you, Julia. Hello, everybody. My name's Charlie Anniss. I work at M&G Investments. I'm part of our Sustain and Impact team, and I'm the lead fund manager for our Nature and Biodiversity Solutions Fund.
Thank you. And I'm going to throw in the quick comment that I think most of us will know clients who actually care quite a lot about nature, and we've got filters around this on Fund Eco Market. So to find these guys and other funds that focus on nature as well, there's like a whole section on our database that enables you to find them, because I think this has just been the poor relative for far too long. And now I'm so pleased that, you know, really great companies like both of yours have got funds that specifically dig into this. Long overdue, should have been there years ago, but genuinely delighted it now exists. So let's hear a little bit more about your strategy then. So let's start by exploring the issues, if we may. So what the main nature-related areas then that you're concerned about? You know, what is it you're focusing on, and why are you actually doing that? Shi, would you like to start?
Sure. First of all, we have to define what nature is. Surprise, surprise. Like, that itself is difficult. So, but put it very simply, there are two schools of thoughts around it. One is nature is everything non-human, everything on Earth, non-human. And the other view is nature and human are part of the same thing. And what we do when we are investing in this particular area and focusing on biodiversity, which is essentially the variety of life, and it's part of nature, a way to describe it, we take the view of a human-nature nexus, meaning we don't think you can address nature problems or biodiversity without addressing the social problem. So social, we need to build a resilient society in order to sustain the positive changes we make to nature. This, in impact investing, is called the impact permanence problem. You can go to Indonesia and you can say, let's stop palm oil, let's restore the land. But then meanwhile, all the communities around it is completely dependent on palm oil plantation for their livelihood. What do you think is going to happen 2 years later? They're going to go back and chop down trees and then burn them and then actually grow palm oil. What you need to do is to bring them into the mainstream economy, provide them with a microfinance, get them out of that unhealthy dependency with nature. So we have a long history of investing in different areas that contribute to biodiversity. So big drivers such as water, climate change, land use, etc., eutrophication, acidification, all these areas. We started our water strategy in 2000 when everyone was obsessed over .com. Okay, we launched a water strategy, people thought we were fools, but now it is a 10 billion strategy and deliver 3% annualized excess return versus MSCI equity. So we have a long history of doing this, and we launched the strategy of regeneration 3 years ago, particularly to sort of bring that holistic framework together, to help people assess investing into the different drivers that are hurting nature and hurting biodiversity in a holistic and scientific base. Yeah.
Thank you. Charlie, would you like to?
Yeah, thanks, Julia. Yeah, so, I mean, you alluded to the fact that nature has played second fiddle to climate for some time. And, you know, I think it's really important to recognize that there is now a lot more focus on nature, which is fantastic. And nature had something of a kind of Paris moment in 2022 with COP15, which hopefully all of you heard and read about. And at COP15, the Global Biodiversity Framework was signed, 196 countries, which put together 23 targets for 2030 and 4 main principles for 2050. So that's brought a lot more focus on nature from a policy and a regulatory perspective. Obviously, one of the targets from the GBF was Target 15, which is around disclosure, and we've heard a lot about disclosure in climate today, and there is increasingly more and more disclosure coming up for companies around nature. The TNFD, which published its initial draft in September 2023, is now 2 years old, and they've just announced that they have 620 companies which have signed up to be adopters of the Task Force for Nature financial disclosure recommendations. So that's a great progress that's being made. And actually, we speak to a lot of companies who are now not, they may not necessarily be adopters, but they're actually looking to align to the TNFD. They're looking at their nature-related impacts, the nature-related dependencies, and the risk and opportunities that stem from those. And that's starting to make a real difference in terms of the way these companies are looking at their strategy and their governance. So that's super important, and that's really coming into the mainstream and starting to make a difference. We also see, actually, I think it was mentioned in one of the, in fact, a couple of the presentations earlier on, we see investors, and in particular on the institutional side, and asset owners looking in a lot more detail at nature and biodiversity. And I think somebody mentioned very specifically the Dutch pension fund, which had moved away from BlackRock and into various European fund managers, including M&G was one of those. And interestingly for PSZW, they have, for their impact, or their strategy is all driven on impact, but they have 3 main impact areas that they're looking at. One is climate, one is human health, and one is biodiversity. So from those longer-term investors, those asset owners, those institutional investors, they're starting to look much more prominently at nature and biodiversity.
Brilliant, thank you. And just striking, following on from what Solly was saying a moment ago, TNFD, I like the fact it uses the word nature. You'll notice I've done that in the title here too, because any of us who've studied any of this area at all and read up on it over the years know it as biodiversity. But that's not the word that's going to land. So I like the fact you swapped interchangeable, both of you, I think, chopped and changed between them. I think that's really important. It brings people in as well. Maybe if we can start with you, Charlie, just by talking about what you look for, and when you're looking for suitable investments, and not a good investment opportunity, but good for nature as well. Can you tell us a little bit about what you actually look for? What's the day job?
Sure. So we're a group of investors within our Sustain and Impact team. We run 4 impact products. One's a global impact fund, which is a headline impact fund looking at solution providers, societal and environmental solution providers. And then we have 3 vertical funds that feed into the main headline portfolio. One is a diversity and inclusion fund, one's a better health fund, and then there's the portfolio that I'm responsible for, which is our nature and biodiversity solutions fund, which covers all the environmental themes that feed into our global positive impact fund. And the idea of our portfolio is to look for environmental solution providers, companies that are addressing the challenges of biodiversity loss, climate change, and the degradation of nature. So the way we've gone around putting together the framework for our portfolio is to think about the drivers of biodiversity loss. We've taken inspiration from the planetary boundaries. So we look at those drivers of loss, being things like land use change, climate change, pollution, excess use of natural resources. And we've built a framework of 6 main impact areas that we can invest in, different solution providers which sit in circular economy, clean water, agriculture and forestry, sustainable food, green tech, and clean energy. So that's our thematic framework for the kind of companies that we can invest in. the universe that we look at is around 250 names. So effectively it's a subset of our broader impact universe. And the main kind of business rationale for the growth rationale for looking at those kind of companies is that they typically have really interesting long-term secular growth drivers in their end markets. So typically we're looking within these solution providers at companies that have regulation on their side. They have a lot of innovation going on, and they have consumer demand, industrial demand, which is supporting them. So that's on the sort of thematic framework, the way we put that together. And then, from a bottom-up fundamental perspective, we are long-term investors, so we take at a minimum typically 5 years investment horizon because we need to give these companies time for the investment thesis to play out, long-term support, patient capital, and we're quality investors. So we look for quality companies with above average return on capital, solid balance sheets, attractive margins, companies that can reinvest and take advantage of those solid structural growth trends in their end markets.
Okay, so question that springs to mind, actually maybe you'd like to answer it because I suspect it might be a little bit similar. But so are we talking about pure play companies there? Or are we talking about companies that do lots of different things that have got areas where they're exceptionally good and positive?
So we have a different selection process, and we can talk about that. But in terms of companies, they typically are not pure play in the sense that, I don't want to name the name of the fund, but it's not the bleeding edge companies. They're not ones that are following the hypes, right? They seem very, very pure, but they're very small. They're very volatile in their earnings. It is not exactly the type of place we want to play, and we don't want our clients to experience that type of volatility.
So okay for retail, if you like, for the backbone of a portfolio. Yeah.
So the portfolio would be based on a group of companies that are typically already some kind of a leader. They're regional monopolies, they're duopolies, things like that. They typically command a stable organic growth top line and high margin above peers. Strong moat. I think we're similar in the sense that we're focusing on quality, but usually these companies because they're solutions providers, they have multiple end markets to play with, right? So that also diversifies some of the risks associated with the underlying market cycle within each end market. So if the EV market is not doing well, the industrial automation probably is doing okay, and perhaps the AI and data center end market is doing particularly well for a company that's making semiconductor chips, that's focusing on energy savings and energy efficiency that feeds into each one of these end markets. The way we screen our companies is really based on decades of experience running what we call the planetary boundaries framework, looking at taking a life cycle view, meaning from cradle to grave of a product. This glass of water, the glass itself comes from somewhere, and eventually it's going to land somewhere. Along the way, there is environmental footprint, impact along the way, and we have been doing this sort of assessment at the company level through a top-down model for many years. And in the case of investing in biodiversity, we're really looking at what is the company's life cycle footprint on biodiversity, considering where in the supply chain these impact can occur. It's a 400 million data point model, big model, and we cover 20,000 unique value chain. And from there, we can identify a universe of about 400 names, and then we'll do the sort of quality approach, fundamental analysis that Charlie has spoken about. I think I'm very pleased that we're on the same panel, actually.
Yes.
Just not that long ago, we were speaking with a group of, was it Iberian, Spanish, clients as well in Oxford. So it's always good to see more players like us in this field. Yeah.
Yeah, brilliant. So whilst we're not talking pure play, we're clearly talking impactful, positive. You're looking for companies doing good things. Just partly because this gets talked about so much in regulation now, but can you touch on particular metrics and things that you use to assess whether or not something's good or bad or indifferent? And maybe things like if you're an intermediary, an advisor, or portfolio manager, what they might want to look out for when they're trying to work out if someone's serious in this area? Would you like to start, Shi?
Yes. So I want to say it in a very simple way, I think, because biodiversity, essentially, if a company is causing a negative harm, a harm on biodiversity, on nature, essentially you're killing off the species, okay? So that's put it very simply. And there is a way to measure the potentially disappearing fraction of species, and that is the metric called PDF. So for every company...
What, sorry, of?
Potentially disappearing fraction of species, PDF. So basically how fast a species is disappearing in a particular area.
Okay.
So that is a commonly used metrics in life cycle assessment. Okay. And for every company, you can assess what is the revenue weighted, so PDF. So basically, that is driven by a number of things, right? It can be driven by climate change, how much emission the company release, how much water it uses, how much land it uses. So it takes into account all these factors and it summarizes it into one metric. And that, it's very transparent. Like the way we do it is science-based, it's transparent, and we need to be able to evidence that impact. Otherwise, our clients will not be convinced. It's exactly of, we're talking about all the things that you mentioned earlier. How do we prevent impact washing, greenwashing? We have to evidence impact, we have to assess impact, and we have to take into account holistically a company's impact across the life cycle.
And Charlie, so metrics, things that you look for, things that these guys might want to look out for?
Yeah, I mean, it's a very difficult subject because there is no one single way of measuring biodiversity or nature loss in the same way as there is for climate with carbon. So it's a very emotive topic. The way we address measurement with our portfolios is we look for bottom-up KPIs for the companies which are entering into our watch lists, into our universes. So any company that we're analyzing, we will seek to find an ultimate KPI that makes that company measurable, makes the solutions, the products and services that the company's delivering impact on, that we can attach a KPI to that. If we can't, we'll engage with the company to try and find a way of delivering a KPI over time that we can measure and monitor and track over time. So for companies in the portfolio, if you think of let's say a water treatment company, it might be liters of water avoided, use avoided. For a waste management company in the circular economy, part of the portfolio, it might be tons of waste avoided. For an agriculture or a forestry company, it might be acres of land sustainably managed or improved. So these are the kind of real-world KPIs that we look for, and we try and track across the portfolio, different segments of the portfolio over time. And then what we've done with our data team in conjunction with TNFD, but also with Bloomberg, is we have looked at company disclosure and third-party disclosure on what we think are nature proxies. So, getting started with what we have, what's available in the marketplace, and the data team have put together using 60 different data points from areas like water, areas like waste, areas like deforestation. And ultimately what we do is we put those together into an aggregated heat map, which enables us to look at our portfolios in a holistic way. We can look at our mainstream portfolios across the floor to look at the more impactful sectors, more impactful negative impact areas of the portfolio to understand what's going on. For our impact portfolios, it's incredibly useful because what we can do is we can look for outliers, we can look for data gaps, and that then feeds back into our engagement programs with the companies that we're investing in.
Cool. I've got loads of thoughts going around my head at the minute, but one is I haven't seen any red cards or anything go up. So are you all with the speakers here on this? Because this all sounds like really normal, real world, like human speak to me. And maybe that's one of the innovations of this area, having come along after climate. Maybe we get to talk about normal stuff that real people care about and can actually visualize. So maybe that's one of the exciting things about this area, who knows? But I want to check in with the audience to make sure that, are you guys, yeah, okay, so you've had the opportunity to wave your red cards if you wanted. Brilliant, okay. Really good stuff. So, I think my next question I wanted to ask was around, example actual companies. So, bring it to life. So, if these guys sat in front of clients, so who do you invest in? Can you give us some examples of any assets? I don't know, would you like to lead?
Sure. First of all, I'm very pleasantly surprised that nobody raised a red card on my PDF per US dollar. Wow. I need to go back and tell my team. That's great.
Is that 'cause I
no,
asked?
but if you do have questions, feel free to come back to me afterwards. Two little stock. One maybe a lot of you have heard about. It was during those ESG bubble years. It's the ESG darling. It's called Ecolab. This company, when we started the strategy in 2022, it fell significantly after the bubble burst, okay? And, but hey, here's the thing. We launched our water strategy in 2000. That stock was traded at $20 per share. Okay, today it's traded at, I think, just checked, 278. When we bought it for the regeneration strategy at the end of 2022, you can see that it's a local trough. Between then and now, doubled.
Can you tell us more about what the company does?
What the company does, you will see them, the soaps and the cleaning agents, etc. But what you don't see is actually what they do with their customers. And they have these great concepts around circling the globe, circling the customers, basically maximizing the return on investment for their customers by saving water, saving waste, reducing pollution, and essentially helping their customers improve water treatments and provide better products and improve their operational efficiency. Now, the stock like this, it has a fairly large market share. It's growing top line, organic growth 5 to 7%, 20% operating income margin. It's a leader, obviously, in the space. But I was trying to illustrate the fact that we are not investing in a company because it has a good ESG rating. The company has phenomenal ESG rating. But I actually thought the speaker just now from Futera made a really good point on Madonna, because she has been reinventing herself over the years. A company like Ecolab that was selling soap back in the days has also innovated itself over the years. Don't tell their company that I said they are Madonna.
They're a bit like Madonna. Yeah. They might like it.
But they have adopted AI and digital services and really helped to maximize operational efficiency for their customers. It's really about servicing clients, isn't it, at the end of the year? And another company, it's called Nubank. Very quickly, it's a digital bank that's based in Brazil, expanding in Colombia and Mexico, right? Scaling up, has about 100 million customers, one of the largest digital banks. A lot of people don't know. But what it does is it really brings the underbanked people who don't have access to banking, to the mainstream. And they have grown phenomenally well managed by a team. And stocks up 44% year to date. It's part of our thesis where you got to make the society more resilient in order to bring about the wholesale systemic change of driving a more resilient nature. Yeah,
making change possible. Charlie, would you like to talk to an example?
Yeah, sure. Okay, I'm going to ask a question to the audience here, if that's okay. Does any hands up if you know of the company Veralto? Brilliant. Okay, that's fantastic, because that's part of the pitch, is it's not very well known. So Veralto, and the reason it's not very well known is because it was spun out of Danaher almost exactly 2 years ago, and it was the sort of slightly unwanted child within the Danaher stable of businesses. Danaher focusing very heavily on life sciences, and Veralto was the environmental and applied solutions business. They've got a very heavy focus on water, so water monitoring, water analysis, water treatment. They're famous for their Trojan brand, which has one of the largest market shares in ultraviolet filtration. So it really plays right into the theme of recycling and reuse of water, which has got incredibly strong growth drivers behind it, both from a regulatory side. If you think of regulators around the world trying to drive industrial reuse of water because it's such a scarce resource, but also corporates who are looking to mitigate against the risk of not being able to have water for their operations because of climate change is increasing the preponderance of drought and flooding. So very strong growth drivers, plays right into SDG 6, clean water and sanitation. And then, of course, because it's been spun out, it was slightly unloved. It now has its own currency. It has a very strong balance sheet because it's very, very strongly cash generative, less than 1x net debt to EBITDA. And that means that they've been focusing more on revitalizing the new product development, upping the growth rate, and also they're looking to do interesting acquisitions to complement that increased organic growth rate. So really exciting name, very pleased that very few of you have heard of it.
It's probably just fund managers putting their hands up earlier who had heard of it.
There are a
probably.
few people right at the back, so yeah, no, it's good.
Yeah. Any excuse me, any other, or should we go on to maybe the next question, which is around what does the future maybe look like for this era? I'll start with you first, if I may, Charlie, this time.
Sure.
So future outlook and any other closing comments.
Sure. I mean, I think, interestingly, we're very excited that this is a sort of new area which is being, getting a lot more focus and a lot more attention. The space that we're in, which is sort of broadly looking at funds which have a focus on nature or biodiversity or a combination of the two, has grown from basically 0 AUM 3 or 4 years ago to around 1.5, 1.6, depending on whose numbers you're looking at. MSCI put out a study last year of around 24 funds with 1.6 billion euros of AUM in them. So it's a growing area. I think also the point that I mentioned earlier about the TNFD and the growth of the TNFD is super important. You've got 400 corporates in there. You've got 150 financial institutions which are signed up to the TNFD, and quite a large number, increasing number of asset owners. So I think that the future is bright for further growth within that space, and we really find lots of great solution providers with interesting growth drivers in their end markets to invest in.
Brilliant, brilliant. Another reason to be cheerful. I think that takes me up to at least 6 now out of my 3. Shi, would you like to comment on future outlook?
Sure.
And any final thoughts as well?
Final thoughts. Okay. So 2 main things I want to share with you on the outlook. One is that despite what you hear in the media headlines, there is a very big mega trend, or whatever you want to call it, that's going on in the United States. 2.6 trillion of infrastructure project has been built, has been announced. Only 15% has broken ground, and this is all through the administration, thanks to 3 big drivers: reshoring, electrification, and AI and data centers. Okay, our strategies are positioned around it because, why? Because AI uses way too much energy. There's not enough power for people, so you've got to solve that problem. And there's massive growth around that because there's huge capex going to building out those AI and data centers. And we invest in solution providers that enable energy saving and water saving around the building of these data centers. Okay, so that's one, that's huge. Second is climate resilience. This is a serious problem. If you look at how much US actually has to spend, the government has to spend last year on climate resilience, so mitigating the losses around climate resilience. So climate change problems, so extreme weather events, you name it, floods, fire, etc. 560 billion, okay? So it's a huge area that will increasingly get into the top of mind for managements across corporations. In the past, it was a cost that is incurred, that's borne by the governments and by consumers. So you and me, we're paying more electricity for insurance, etc. But now corporations are finally feeling the blunt of it because their factories are experiencing extreme heat, water flooding, mega storms, etc., etc. That is an area that we are seeing an emergence of interest, both from an investment community, but also from companies that are offering solutions to design more resilient infrastructure, to design more resilient solutions that help our buildings, help our coastlines, and help our cities become more resilient to these extreme weather events. So 2 particular areas of drivers. And lastly, I think to sum up, the Pictet regeneration strategy is really, at the end of the day, trying to solve a problem, which is biodiversity loss, in a holistic way. We try to be as transparent as possible, leveraging all the metrics we can, and taking that whole of system approach to invest, which give us a fairly large investable universe to play with, fairly diversified portfolio. And we are here, and Pictet is not going away. We have been here for 220 years. We have a 70 billion platform in thematics. We are ready to have more conversations with you. I have my colleagues within the audience as well, so feel free to reach out to them as well.
Well, here's the next 220. Charlie, can I ask if you, I'm not sure any of us will see that. Charlie, did you have any other closing thoughts that you wanted to add at all?
Yeah, no, sure. I mean, I think I said a couple of them already. You know, we think it's a really interesting space to be investing in. One of the things also that is, I think, very exciting for companies that are looking at their nature-related financial risks is it's really enabling them to increase their resilience, and you know, companies are getting there's much more a much greater understanding within the market from corporates around the you know, nature-related financial implications. So that is much more prevalent in the market. You think of, and actually the TNFD published a report on this recently, writing about cases of, you know, extreme and financial materiality, yep. Which is a really interesting report. And obviously the kind of main headline one to think about is 3M and the massive fines that they've had to pay for PFAS remediation, sort of $12 billion US, which they've had to pay so far. So companies, you know, mapping their nature-related financial risks have that in the back of their mind, and then it's also connected, I think, to climate change. You know, with the increase in extreme climatic conditions, floods, droughts, and companies, whether they can actually continue to operate, and whether they're going to have stranded assets, whether they're going to be able to continue their business operations if they can't have those natural resources like water available to them. So there's a real crossover between climate and nature, which I think, yes, is something which is really worth sort of exploring and digging into. I think
hugely well worth exploring. I mean, admittedly, another time, but to me, I always struggle a little bit that we have to put things into compartments in order to have serious, deep conversations on them, but they're all completely the same thing in so many ways. They're just not separate issues. They are intertwined, overlapping, and interconnected. And with that, I'm going to close this session and say thank you very much for your interesting talk, and if we can thank these guys.